Hello, welcome back to the channel. So in today's video, I'll be covering a few different portions. I'll be covering a stock that I just sold. I'll be covering a stock that I just bought, as well as Google stock. So yes, I just bought a new mic as well as a boom arm. So hopefully the video qualities are a lot better right now. So let's get into this video. And the first stock that I actually sold is United Health. So for United Health, I actually trimmed a portion of my position just a few days ago. And United Health is having their earnings next week. So United Health is getting a bit too big in my entire portfolio. I don't feel comfortable holding this one for the very long term. It's actually a company that was in my portfolio because it was undervalued. So for me, I don't think United Health is a business that is great in the long run. I don't see myself holding this for the next 5-10 years. And going into one of the biggest earnings for United Health in its recent years, I think it's right for me to de-risk this position, to take some off the table to reduce my exposure to this company. And I actually bought another company using all these proceeds, and this company is VeriSign. So VeriSign is an extremely boring business. They don't do anything, and the stock actually fell around 10% today. So for VeriSign, their earnings were quite decent and they're seeing growth across the board. So what the company actually does is they sell your .com domains. So if you go to a site like GoDaddy, if you were to sign up for a website, GoDaddy pays VeriSign for them to get the .com domains. So for VeriSign, it is almost a monopoly in the entire world, because for a company to get a .com domain, they need to pay VeriSign in some way, shape, or form. And VeriSign is the only company in the entire world that is able to supply all these different .com domains. So of course, there are competitors as well. You have your country domains like .sg, .uk, .xyz and so on. But for VeriSign, they hold a significant portion of the entire market share, and I don't see this going away anytime soon. So for VeriSign, the business is extremely simple. The business is just a cash cow that brings in cash and prints cash every single year. So what they're doing with this cash is they're trying to give it back all to shareholders. So as you can see here, almost 100% of the free cash flow is being redistributed back to shareholders. They actually raised debt a few quarters ago to buy back shares. That was a very opportunistic time for them to buy back the shares. The shares were extremely depressed. That was when I was looking into this company, and currently now the company is also buying back the shares. So for VeriSign, they recently signed an Icon agreement. It's an agreement that allows VeriSign to continually sell their .com domains and for them to have price increases in the last 4 years of the 6-year agreement. So Icon actually signed this agreement with VeriSign. So what this agreement encapsulates is that VeriSign can only increase prices by around 7% in the last 4 years of the 6-year agreement here. So if you were to spread it out over the 6-year agreement that they have, this is actually a 4.6% increase. In terms of pricing, almost every single year, that's a CAGR. So for VeriSign, I think this company is easily a 10% grower over the next few years. And if you were to put it into a EPS calculator like this one, assuming 10% growth, so they give back almost 100% of their free cash flow, which is around a 4.5% yield, and assuming they grow pricing at around 4.6% or so. So that's around a 9% already. And if you include the volume increase in terms of the number of domains, then this will give you around 10% earnings growth for the company. So assuming a 28 times multiple for VeriSign, and assuming the price today of around $230, the company will give you around 11% CAGR. So I think for a company that is as wide moat as VeriSign, it's not a company that people talk about a lot because it's an extremely boring business. But if you have to look at all the metrics, the gross margins, the operating margins, the net income margin, the ROIC and so on, VeriSign fits the bill, and it is actually a Warren Buffett holding as well. So Warren Buffett actually added to his position at around $200 a share last year, and that was when I started looking into this position with a friend of mine. And I missed out on this company's entire run this year. It went up all the way until $300 a share, and currently it's trading back down to around $230 a share. So hopefully the company falls a lot more. I view this as a high moat, high quality business that has a moat that's on par with Visa as well as MasterCard. So that's why I added to this position. I took my United Health gains and my trim as well, and I transferred it over to VeriSign. So next portion that I'll be covering is Google stock. So Google is up around 3% today again. And for Google today, the reason why the stock is up is because they signed an Anthropic agreement. So they signed an agreement with Anthropic, it's official now, that it will be worth tens of billions of dollars in 2026. So Anthropic is using Google's TPUs rather than Amazon's TPUs because Google's TPUs are a lot more high performing as compared to Amazon. I'm not going to sit here and act like I know a lot about this. And and overall, I think the markets today are pricing in the growth of all these companies as though hardware demand will continue going for the next 5-10 years or so. And all this credit being raised to basically fuel data centers without actual ROI is getting concerning. And for Google stock today, the company is actually trading at a price to earnings of around 30 times. This is normalized earnings, of course. So they actually had a lot of one-time net income increases in the past earnings quarter. So unless the company can sustain the growth, which I think it should be able to, over the next few quarters, maybe the next year or so, I think the company today is getting a bit overvalued, is getting into the trim territory. And overall in the markets today, the markets in general are quite expensive. So I'm not finding deals, I'm seeing all this AI hype, I'm seeing all the companies attached to AI running, and non-profitable companies are also running up in stock price. And non-profitable companies are also running up in stock price. It's a lot on momentum today, and the markets are currently at all-time highs again. So I'm actually thinking of trimming my position, and one position of mine that I'm thinking of trimming is actually ASML. I'm not planning to sell my entire position, of course. The company is still high quality as ever, but I'm thinking of trimming my position simply because of two different things. Number one, I think the AI bubble is starting to come up. I'm sure we all know about the seller financing. I'm sure we all know about the lack of ROI when it comes to AI. That's one. Second thing is ASML's valuation as well as the company's complacency. So I've been speaking to people in the industry, and so far what I've gotten is that ASML is complacent. ASML is similar to what Nokia was back in the day. When Nokia was complacent, they were saying that, oh, Apple is not going to come up with a technology that is similar or even better to theirs. So ASML today has the superior technology, of course, but what I've gotten is that the culture there is not as great as what it is supposed to be. So the consensus is that they're underestimating China's ability. Of course, China could be years and years behind ASML, but in the future, when that actual technology comes, ASML will not only lose the 20% of revenues from China, they will also lose out in terms of market share. As for the other companies in my portfolio, I think my portfolio is decently sized today. So the markets are overvalued, that's why I have this cash position here. As for the other positions in my portfolio, the ones that I'm looking to increase allocation to will be Visa, MasterCard, Copart in the future once the stock price continually comes down. I think the stock is still a bit expensive for me to go in with a full position. The company has secular growth trends, and it's a compounding machine that will keep going on and on. And then for the other companies that I'm looking to add as well, I think ASML is closer to a trim, Google is closer to a trim also. Amazon is okay price today. I wouldn't say it is expensive. I also wouldn't say it is extremely undervalued. United Health is a company that I just trimmed. So this allocation is what I feel comfortable with right now, around 4% allocation. As for some other companies that I'm considering as well, considering Honeywell, Mercado Libre, and I recently added into VeriSign. I think it's one of these companies here. Last portion, just answering some of your questions. First one, it says, hi Guan, what do you think about the stock BAH? It's a value stock in your opinion. I'm not too sure about this company. I believe it is Boo Ales, something like that. Not too sure about this company, so unfortunately I can't help you with this one. Second one is Grab. What do you think about Grab? I think Grab is a company that is expanding its moat, but the problem that I have with the business is the company doesn't have pricing power. So the company is a Singapore-based company. I'm familiar with it. Actually, in Singapore, the drivers here are the ones pressuring Grab. As for overseas and other countries like Indonesia, like in your Southeast Asia companies, they're actively expanding their offerings, so they're going into digital wallets and so on. I think it's a bullish thing for the company, but it's a company that is still too early for me to invest in. Next one, with Brazil's Supreme Court ruling against Netflix, you think other countries will follow and file tax claims against Netflix? I'm not too sure. The stock broke 200-day moving average. I see the stock going lower. Again, I'm not too sure. Netflix is a company that is highly priced today. In order for the stock to justify its valuation today, around a 45 times of earnings, it has to grow at upwards of 20% for the next few years. Of course, the company is a great company, a mature company that is still growing rapidly and expanding its margins over time. I would avoid Netflix at today's price. Next one. Hi Guan, what are your thoughts on Spotify? Spotify is a decent company that has a recurring revenue coming into the business, but the margin is substantially lower than other companies like YouTube, for example, because they don't own the music. They have to pay the licensing fees, and majority of the revenue made is actually paid to the artists themselves. So for Spotify, I think the valuation today is extremely high as well. So this is a company that I would avoid. Next one, hey Guan, what are your thoughts on Pinterest? They have strong metrics in terms of revenue growth and low debt. In the social media space, you're better off investing in Google as well as Meta. These two companies are the strongest one in the entire ad space. For Pinterest, I'm not too sure. The company, I don't use the app, so this is an avoid for me. Next one. Hi Guan, thanks for the video. What is Substack? Substack is actually a newsletter that I release. I'm doing this with a friend and I'll be releasing 1 to 2 newsletters on companies that we cover every single month. It'll be extremely extensive, so feel free to check it out in the description below. Next one, it says, hey Guan, has the market already priced in the debt wall maturity and the valuation of S&P Global and Moody's? I want to buy SPGI, but it seems like the stock and Moody's are almost fully priced to perfection. For example, Moody's beat earnings and yet still dropped slightly. Do you think that is likely to happen for S&P Global after their earnings next week? I think S&P Global will beat their earnings as well. And for S&P Global, it is an equally good company as compared to Moody's. As for the stock price today, I think S&P Global is decently priced. You have the catalyst coming up in terms of the spin-off of the mobility segment. So that could be something to look out for as well. S&P Global is currently trading at a 27 times price to free cash flow. And based on their end of year metric, currently trading at a 26 to 25 times price to free cash flow. I think that is reasonable for a company as high quality as Moody's. And it is actually a discount as compared to the markets today. Next one, can't wait for the Substack. Thank you. Next one, that's mine. Next one, Netflix long. Okay. Next one, for Melly, shouldn't fintech lending businesses be trading at a valuation discount due to credit risk involved? Take AXP for example, they were trading at a 18 times PE. Also, I don't see anything sexy highlights like sustainable mode except for its large TAM and quick growth. So for Melly in Latin America, the great part of the business is the network effects, of course. So most of us, we don't live in Latin America, so it's a bit hard for us to imagine it. But go and watch some Argentina vlogs and go and watch some Argentina videos, the people there using Mercado Libre's platform. And for Mercado Libre, of course, it is not a multi-business like, for example, S&P Global. It's not a multi-business like Moody's, like Google, like Visa, like MasterCard. But you don't always need the strongest moat for you to get the best returns. And for Mercado Libre, I would say the moat for the company is simply just the physical asset moat, as well as the actual network effects and the infrastructure, as well as the data on their platform. So Mercado Libre currently holds around 28 to 30% of the entire market share there. I mean, if you're to make that argument, then Amazon doesn't have a moat as well. So Mercado Libre, it's a company that has a large tailwind behind of it. So I would say the large tailwind behind of it more than makes up the inability for the company to have a massive moat like S&P Global. Last one that I'll be covering, what about Equifax and Constellation Software? So Equifax is a company that is expensive in my opinion. The growth isn't justifying the valuation today. Currently trading at a 44 times price to earnings and growing at around 11 to 12%, and revenues are up at around high mid single digits. So for Equifax, I think the more superior company in the space is FICO. That's the company that I hold my position in. As for Constellation Software, I don't really like acquisition businesses. They are unpredictable. And the only company that I would invest in that is something similar to Constellation Software is Berkshire. But yeah, I hope you guys have found this video useful and feel free to drop a comment below. Invest safe.